Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Vinod Karki, who's the head of equity strategy at ICICI Securities. Viewers would remember, actually, a few days after they came out with that note, we did a conversation about what could the possible scenarios on the Indian markets be, and they got it right. The question is, therefore, in the latest strategy note, when they are talking about relative caution, why is it that they might be doing so? Vinod, you may not have spoken about it in as many words, verbatim, of course. But firstly, thank you for joining in. But do tell us, how do you feel about the equity landscape after the rallies that we've seen? Though I must say, after the November top of sorts, we've come off quite a bit as well from relatively from the 19,000 levels.
Yeah, thanks, Neeraj. So market, if you look at how it is stacked right now, we are entering 2022, I think, where 23, where I think the volatility will be comparatively lesser compared to what it was in 2022. Just if you roll back, 2022, we started with Omicron. That was followed by the whole Russia-Ukraine conflict and that inflation rising significantly in the developed markets. People fearing that we'll have a 60s, 80s kind of an inflation cycle, and then after that, mid-year later, the Fed started hiking with those jumbo rates, So I don't foresee those kind of activities this year. It will be relatively, obviously there will be a lot of uncertainty as it is every time in the market. But those kind of mega events, I don't foresee. So first of all, I think the volatility will be lower. I think that is clearly being reflected the way VIX, if you see the fear index, India and US has actually slumped, So I think that is one thing which will keep equity valuations a little elevated. But having said that, if you see historically, when we move beyond the 20x forward PE, we did this analysis for last 20 years. The expected return for the next 1 year falls. It falls to single digit kind of returns. Although there is, you have instances where there is negative returns and there is positive returns. But on the whole, if the economic environment, domestic economic environment supports and the Fed quantitative tightening cycle recedes, there is no reason to believe that we might have medium kind of slower returns, but nevertheless positive returns from equities in 23.
But this is for the year at large, right? So it may well happen that in the intermediate period for the first half, maybe, if indeed there is a recession-led pullback in the global markets, then in Indian markets for that interim period could correct from where we are right now.
Absolutely. Yeah, absolutely. And so, as I said, we are reaching that stage where it runs into high optimism environment, 20 plus PE forward basis. But you have to remember that the VIX is suggesting that the fear is receding. So people are becoming more complacent about that things are fine, things are improving, and those kind of things, which eventually leads into a situation where we get into bubble territory. So typically you have seen that from 20 to 22x and 22 to beyond is where the real bubble sets in India, if you see historically. In October 21, we exceeded, we are almost 22x basically. And from there, we started correcting. And now we are again more or less at 18,000 odd level on the index. But earnings base has increased. So that's why we are hitting that 20x, right? Because, last year we were at 22x and beyond basically, which typically we have seen is the situation where we get into bubble territory. So we are just entering, if you may call it the optimism or the bubble territory, not yet at the top of that side, this thing. So, but if the way the narrative is building up regards India's domestic cycle, if that continues, there is if the US Fed starts hinting that later on during the 2023 we'll have, because market looks at forward, So if the forward guidance is that the rates will start tapering down because inflation is not too high, and environment for growth is reasonably okay, right? Then I don't see a very bad situation for equities in 23. But we cannot expect very high returns.
Okay. Vinod, what India does, would it be a factor of what happens to global markets? Or do you reckon if global markets are benign, then while the headline numbers may continue to be stagnant or not giving great returns, but sector specific and stock specific action could be very pronounced? Or do you think even that will remain dull?
So the market risk is always there, Neeraj. So what I mean by that is global environment for equities is turns sour. If all equity assets starts declining, then India, no way India can outperform or rather have positive returns. But if globally equities are reasonably okay, then it will be a matter of whether India outperforms or not. So to that, I feel that seeing the performance that we had this year, it may very well be the case that next year we may not outperform compared to some of the other emerging markets which have not performed to the extent India has performed. So yeah. So that is how I look at it. And what was the second question, Neeraj?
No, so what I meant was that if the headline numbers kind of stay sedate, would it mean that the broader market action might also remain sedate because it's been fairly choppy in 2022? Or do you believe high stock market, high octane stock specific action could continue?
Yeah. That's important. So what we are observing, and we have been writing continuously about this thing, is that within the economy, which is being reflected in stock performance, is that the old industrial capital intensive credit cycle driven cyclical stocks are outperforming. It is a very surprising thing. People have maybe not noted it, but last year, given the volatility, these type of stocks typically underperform significantly. Because their flight to safety happens. The low volatility, high expensive, the high ROE companies, those are the ones which outperform. But if you look at the last year's performance, it is all these banks, PSUs, industrials, the capital intensive utilities and all, they have been performing in a extremely volatile situation in terms of market readings. So I think that is what we have been saying. Why this is happening is because the economic revival is being driven by the investment and the credit cycle and the real estate cycle. I come back to that again, which we talked earlier, because over the last decade, these three cycles have been languishing. Whole of the last decade, 2012-13 till 2021, if you see the credit cycle was on a down cycle, NPA cycle was rising, investment cycle was continuously languishing, so was the real estate cycle. So these are the cycles which you see month on month during the current improvement also, that including manufacturing, which is now picking up again. If you see the PMI numbers and all, suggests that this part of the economy, which is the investment and manufacturing and those kind of things, compared to the consumption services, those kind of things, outperforming. So, and the valuations are also pretty reasonable in this space. That's the irony of it, because the last decade has seen the other side of the market really scale up valuation and become extremely expensive.
Vinod, I would love to understand from you. Maybe it's not a part of your report, but since you look at strategy, right? A lot of people at times miss out on what can possibly happen because they see a stock having risen 30, 40, 50% and believe, chalo, now the gain has happened. Now what more can it do? But if I don't know whether you've studied these, but I just want to still ask you, because you may have looked at past cycles. What are the kind of gains that could come into some of these capex related names? Because it's not just the Indian companies, right? Last week, I wrote in my Talking Points newsletter, a Swiss chocolate company set up a third plant in Rajasthan. Skechers is putting up a plant in India and shifting manufacturing to India. Today, there was news that Apple is considering even iPad production in India. We know of the semiconductor investments that are happening. What is the kind of uptick that a capex ancillary company can see over the course of this decade? Because a lot of people say that some of these stocks have run up already. Can you kind of talk about it?
Yeah. So that is a very important question for investing, because the initial, as you rightly said, if you past history is any guide, then we have seen that these investment cycle, credit cycle are not a 1 or 2 year phenomena. They don't. I mean, and to be fair, the market is only discounting currently the announcements made by companies around capex and the involved credit cycle that we might see. The actual hitting on the these projects hitting the ground, project finance starting, that takes time. In fact, so the real numbers will only show up in a year or so, basically. So you're right. Basically, all these capex, apart from these sectors, metals, the large industrial houses like the Reliance, Ranis, and all the capex heavy industries, they already have been announcing. So my reading is that if you see the 2003 to 2012 cycle, almost a decade, it went on for almost a decade. The whole investment cycle and the credit cycle, with some ebb and flow. There was some one year of correction in those stocks. Those kind of things do happen. But what you should try to understand is that where are the tailwinds coming in the economy? So I clearly see in the investment, credit, real estate, and those kind of sectors, manufacturing, getting the tailwinds. And these tailwinds don't fizzle out in a quarter or two or something like that. One may play strategically that something has run up 30-40%, as you said, and maybe take some money, but it will again drop. And because the order books will continue and the growth will continue, again it will form a new high. Basically. That is how I have seen. So put the question you asked. The answer is simple: that these things are multi-year, not just a quarter or two. If it's for real, and I think it's for real.
So how would you play it? Would you play it via the capex? Put the industries which are putting up the capex. I mean, the PLI winners, etc. Would you play it via ancillaries? How would you do it?
So the easiest picking, in my view, are first of all banking. Because banks, because the best, the veterans tell us that, the investment gurus, that the starting point of investment success is that you need to have reasonable valuations. So I think the financials or the banks, if you look at historically, they are at reasonable values. I'm not saying that absolutely cheap, but compared to the rest of the market, they are reasonably valued. And investment cycles, direct impact will be on the credit cycle, and which you are seeing. The industry credit after a decade is picking up into double-digit area. I'm not talking about entire industry credit growth. So that is showing traction. And second, large capital goods companies, L&T, for example, or some of these other guys, not extremely expensive. They have turned a little expensive, but not at one standard deviation or two standard deviation kind of thing. And the value and the earnings growth or the order book will only, as I said, these are what we are getting excited about right now is the announcements, right? The actual numbers in terms of order flow, execution, project finance, all that will start showing over the period of time. Basically.
Got it. Okay.
Yeah.
In the note that you just recently put out, you speak about the possibilities of all of this, and you mention, you end the note with a mention of the words including the real estate cycle. Now tell us a bit about this as well, because we had a really good run from a market's perspective into some of these real estate plays, which has paused because there was this whole RBI rate uptick trajectory, which kind of put a lid, despite the fact that the monthly sales numbers still continue to look strong. Is this also a cycle that could be multi-year, and therefore is real estate as well as real estate ancillaries still a good investment bet, selective as it may be?
So real estate is a very important thing. If you look at the investment rate, the gross fixed capital formation, in 2012, household real estate investments constituted 37% of gross fixed capital formation. So we might keep saying that the government doesn't spend and all, but all said and done, they end up contributing around 16% of the gross fixed capital formation currently. From 37% over the last decade, the real estate's contribution has shrunk to 25%. And over the last year or so, we have started seeing the revival in this sector. So real estate, not per se companies, because there the stock picking is very important, given the nature of the business, the capital allocation, the balance sheet discipline and all, but more on the ancillary, the credit growth, because it has massive multiplier effect. The real estate sector, if it really picks up, has a massive multiplier effect on the ancillary, the discretionary consumption and all, wage growth and all for the workers and for the, for the people who are involved in that sector. So I think that is more important. And obviously, if you can pick up the really good companies in the real estate space where you have confidence on the governance and all, obviously, as I said, these cycles are multi-year. So there will be ebb and flow, there will be corrections, and then again it will pick up. Point is, has the real estate cycle just finished after a year of performance? I don't think that happens. If past history is any guide, such things don't happen.
Got it. Well, my final question, it may not have been a part of your report, but I'm still inclined to ask that to you. And that's on the K-shaped nature of the consumption patterns being seen in India currently. We saw that in the earnings as well, right? I mean, a Bata versus a Relaxo or a Oberoi versus a V-Guard, as the case may be. The commentaries were very, very chalk and cheese. I read this in a DSP mutual fund note. What's your sense? Because a Westlife or a Titan or some of these high incomes attracting companies are posting good results, but they're trading at premium valuations. Do you bet on the ones which have kind of lagged because of the rural demand and might see an uptick, or do you favor the ones which have performed thus far but are trading at expensive valuations?
Yeah, so I would bet on the ones which are trading higher, but growth is coming, because we did a deep dive on why this is happening, and we find that we have found some conclusions. So now the national accounts, if you look at deeply, it gives the entire wage bill in the economy, the cost, the compensation to employees, entire, like the GDP number. If you break it up by institutions, what we realized was the public sector is around 11-12% of GDP. Which has been stagnating for the whole of last decade. So they continue to contribute 12% of GDP as total wage bill in the public sector. Now, what has been gaining traction is the private corporate sector. So from 9%, we are on the verge of exceeding the public sector. We are around 12% now on the private corporate sector. So what it means that the private corporate sector wage bill is growing much faster than the nominal GDP. That's why its share in the GDP is rising, right? While the other side, which is the household, or rather the informal segment, has continuously been declining its market share. Now the point is, the formal sector just contributes 11-12% of the workforce. 88-87% of the workforce is in the informal segment. That's why we believe this dichotomy is coming, because this 11% workforce is still large in terms of number, in absolute numbers, but not entire. I mean, from an overall perspective, it is not huge in the countries, from a country perspective, right? It's just 11-12% of the workforce. So that's why we see these pockets of high income consumption growing faster than the nominal GDP. Whereas the other part of the economy, which is almost like 88%, 87% of the overall workforce, is stagnating because the income growth is not there. It's an informal segment and inflation hit them. So we are very clear that this is the dichotomy in consumption that it's coming out very clearly if you look at deeply at the national accounts. So this space of formal workforce, if you look at the other data, people, the employee provident fund numbers and all. So that also, and tax filing and all, it's very clear that and if you see the survey from a Naukri.com on the prospects of growth in the employment will show you very robust. I mean, they are always talking about 20, 30, 40% kind of growth in some of the sectors. Whereas if you look at from other, which covers the entire nation, which covers those 88, 89% of the workforce, where it's informal, it shows very sluggish growth. So that's because it is superimposing on this growth, high growth base. So we think that this high discretionary consumption is growing faster than the nominal GDP, whereas the bulk of the workforce, the growth is sluggish. And that's why the mass consumption categories will continue to be sluggish, whereas this will continue to outpace. And we have seen that in other countries like China and all, when the income growth started rising, the discretionary consumption grew very fast.
Got it.
Right? Yeah.
Got it. Vinod, this was excellent. Thank you so much for talking to us today on your latest strategy note
Thanks, Neeraj.
and giving us some fabulous insights.
Thanks, Neeraj. Thanks for that.
And viewers, thanks for tuning into this edition of The Talking Point.